Good afternoon, everyone. I am Erich Patten, the Chief Investment Officer at Cutler, and I'm joined today by Bryan Knutson. I'm in our Bellevue office. Bryan is just across the water in our South Lake Union and Seattle office. If you do hear some background noise, our office is right next to where the seaplanes take off. So you may hear some coming and going in the background there, but nothing to worry about. There's a lot of interest in today's webinar, so thank you all for joining us. And clearly, this has been an historic start to the year, and I think that's part of why so many of you have joined us today. But we titled today's presentation, "Is a recession coming, or is one already here?" That's a little bit of a moot point because the markets are trading as if a recession has arrived. But let's start with some disclosures, as we typically do. I think the pertinent information here is that new information comes available throughout the year, and we adjust our market views and our advice based on that. But I do want to emphasize for any of you here today, if you have questions about how this presentation or how what we're saying today impacts your portfolio, give your advisor a call. Bryan's available. I'm available also to answer any questions you might have, or call your financial advisor and see how what we're talking about impacts you on a very direct level. So today's agenda, we're going to take about 45 minutes. We're going to start with some of the hard-hitting recaps and advice that we're giving clients. Then we're going to jump into what you should be doing now and the advice that we're giving to individuals. Then we talk about inflation and the Fed. This is actually the longest portion of our presentation, mostly because it is what is impacting the economy the most right now. So that leads us right into where does the economy stand, and being optimists and long-term believers in equity investing, we're going to leave you with some silver linings and reasons why we think stocks could move up from here. So what investors should be doing right now? Bryan, what happened in the second quarter, and where do things stand right now?
Okay, well, thank you everybody for joining us today. The second quarter was a rough one. It was a rough one for bonds and for stocks. The first quarter, we ended up modestly negative, and that was, including the beginning of the aggression in Ukraine, et cetera. In the second quarter, the story was inflation. Erich already said it. You're going to hear that word a lot today. You've probably heard it a lot for the last little bit here, and it's because it's so important. The impact was on both stocks and bonds, and the impact was more shocking, perhaps is a word for it, on the bond side. We're going to talk about why, but bonds had a rough quarter. They did. And why? Why do rate increases matter so much here? Because every time those rates go up, coupons for new bonds go up, and the existing bonds, the pre-existing bonds, look a little less attractive. That's part of the reason for the sell-off. On the stock side, the biggest drop was on the growth aspect. So that would be, your Amazons and Facebooks and such. We're going to talk a bit more about that later. But the disparity between values drop and growth drop was, again, very sizable. On the foreign side, they did do better than us, relatively speaking, also down, but better than us. The impact over there, a lot of it is on the policy side, a lot of it is on the activity side in places like Russia and China. Alternatives was actually a bright spot. It was, again, it was down. I wish I could tell you that much was up, but it was down much less. So as a diversifier, kind of that third leg of the stool, really appreciate what that class was able to do to help to mitigate some downside.
Yeah, and let's talk about stocks and bonds, the two main asset classes people are focused on. Bryan, there is a lot of data on this chart. Can you boil it down to us to what you think is important at what we're looking at here?
Let's dive into the deep end. So these are two very distinct views. The left-hand side is stocks. That is the S&P 500 going back to 1980. The right-hand side is bonds going back to about the same. It goes to 1977. But the punchline for the left-hand side, the one with all the bars going up and down, is a reminder that stocks go down every year. Every single year on this chart, there is some level of drop. right? Even if those years are not quite as much of a drop as we've seen this year, there are also some that are much worse, right? We know that so far year to date, the worst point, knock on wood that it stays that way, was a minus 24, which seems quite shocking, especially when you come from the high point. Remember, the all-time high was January 3rd. So everything we've seen for this year to date is essentially a drop from that point. But look across that chart there and see a lot of red numbers. But keep in mind, you also see up top a lot of really strong, they're kind of grayish numbers, right? That's the total return for the year. So stocks, volatility there is both healthy, not fun, but healthy, so we don't get valuations that are so insane that we can't even wrap our minds around them. And also, it's part of the deal, right? I mean, if you want to get an average annual return of 8, 9, 10, whatever the time frame might be, they don't give them out for free, right? On the right-hand side, this one is the one that's a little harder to digest because prior to this year, the worst total return for bonds in a given calendar year was 1994. See that one that's highlighted in yellow, and it was about a -3. Okay, that includes the coupons that are received, right? So it's a change in market value plus the coupons. This year to date through June, it was a -12. Now it's closer to about a -10, but still, it's not great. And why? Increases in rates. Just the same reason I said before. Those bonds that I was holding last year that had a 3% coupon, I went, all right, that's about the best I'm going to get. Now I can get with a 5, I can get with a 6. Okay, well, I'm going to punt the ones I had. I'm going to roll into these new ones. That's part of the reason for that drop in market value. We had a lot of overpriced bonds that have now come back closer to fair price.
Well, and that sell-off in bond prices, I think, can be summed up in one word: inflation. You think about a year ago, we were, in the 1 to 2% inflation camp, and today we're at 9.1% inflation. We're going to talk a lot about inflation in upcoming slides, but really, Bryan, we've seen minus 10% in bonds as inflation rose to 9.1%. Do you think it's safe to own bonds at this point?
I think it's safe both to own them and to think about how to take advantage. What we do on a weekly basis is talk about where we should be on that kind of what you call the yield curve. Like, how far out do we need to go to get an acceptable amount of yield? One other thing to note on here, just when we talk about whether it's safe to own bonds, I had as much concern, and we did, I think we all did, in 2019 and 20, trying to rationalize why we got returns that you can see on that chart, if you can read the numbers, almost 9 and a 7.5. We didn't have yields back then either, right? So prices were going up too much. Prices have come down, just like in stocks, right? I mean, bonds they're safer, they're less volatile, let's say less volatile than stocks, but they still have their own pricing pressures. So now I'd say for going forward, what we're looking at is whether to modestly push out duration. Is it worth going out to get a 3.5% yield instead of a 3? Things like that. I'd say, yeah, this is an opportunity set that did not exist a few years ago.
All right, now jumping into stocks, and I think this is really the most important chart that I'd like to emphasize for investors today. We have a lot of clients, and there's a lot of investors across the globe that are worried about the sell-off in equities. And what I think this chart really explains is the kind of Wall Street expression, stocks go up on an escalator and they go down in an elevator. And you can see when stocks go down, it's generally severe and it's quick. And that long climb back is really what we want investors to focus on and to keep that long-term mindset. That's why you have equities. That's why you stay in the equity markets. If you look at the average bear market, it's minus 39%. Bryan already mentioned we got to minus 24, so well less than that average. If you exclude the minus 83% from the Great Depression, that average is 32%, so not quite as far down. I think that's less reassuring for investors that think, oh, is there more downside? Could there be more risk? Well, on a historical average standpoint, yes, there could be, but keep in mind those long stretches of gains are really what we're focused on, and knowing when the market has turned is very difficult, if not impossible to do. We advise staying the course, keeping that longer term mindset and not getting caught up in the short-term volatility if you can do it. Not every stock is down, however. And I think that's important to keep in mind as you look at the stock market. It's not just one monolithic number. This is a chart showing really the biggest tech companies and what they've done over the course of this year. Google, Apple, Microsoft, Tesla, Amazon, NVIDIA, and Facebook. And you can see each of these is down more than the broader stock market. Well, market valuations have come in largely because these stocks have sold off. They're such a big piece of the S&P 500. But if you look beyond big tech and look at the rest of the market, it's typically, and not universally, but it's typically down less than the S&P 500. And it's also typically trading at valuations that are more attractive. And we have another slide on valuations later in the presentation, but this slide I would like to call the value of diversification. Bryan mentioned international is outperforming US, not by much this year. They're pretty much neck and neck, except take into account that the US dollar has appreciated a lot this year. But you can see the discounts that international equities are trading relative to US equities. You have developed markets like Europe and Japan and Australia trading at 74 cents or 74% of US valuations. And then you have emerging market stocks trading at 69% of US valuations. That's even less than it previously has been. And you can see on this chart the differential. But we would expect in an inflationary environment, emerging market economies, and I'll throw out Brazil as an example. Brazil, they have a much higher agricultural and commodity-based economy than, say, the US does, which is much more services focused. In inflationary environments, I would imagine those emerging market economies would do relatively better, and yet they're trading at discounts. We're not recommending overweighting or really going heavily into these asset classes. However, we think it's an important part to have an investor portfolio. Keep those pieces, keep that bond piece, keep that international diversification piece, to keep that diversification so that you can have those uncorrelated assets and those opportunities as they might arise. So inflation and the Fed, and this is our longest section of the presentation. And we're going to start, Bryan, with a quick history of inflation. What does this chart show us?
What this chart shows us is that there are not very many instances where you get what you might want to hyperinflation. I know I'm not going to try to get into sort of overstated ideas, but where inflation gets so far beyond the norm. They are typically related to very specific events. Two of those are world wars. One of them is to try to recover out of the Great Depression. One of them is to try to recover out of kind of a price inflation back in the 70s, which is the closest correlation you'll often see to now. And then you have now. And I'd say, the biggest similarity between these events where you have that big push up is a big push of money. And that's what's happened this time. Sorry, there's a seaplane going by. It's good to see some consumer activity. But what we have here going on is that a big push of money into the system, a big push of activity that has led to a push up in prices. This, I think, the punchline I would get on this one is this has happened before. A correlation to the 70s, yes, there are similarities. They're not entirely the same. The interest rate environment is what's very different. We're going to talk about that soon.
Yeah, and Bryan, I want to point out one thing before we show the data on the Fed that's really driven a lot of this inflation. But look at these S&P 500 returns. These are annualized numbers in different inflationary environments. Stocks love low inflation, and getting inflation under control is very important for the stock market. It's very important for the economy. That's going to be something that is essential for us returning to that growth in the equity markets. But Bryan, really, how did we get to this point in terms of policy?
Well, okay, I'm going to try to be diplomatic when I say that it has been a series of errors by the Fed and others, but largely by the Fed. So what has happened is a year ago, 2 years ago, the projections were that that the interest rate, the Fed funds rate, the short-term rate that is that's the oversight of the Federal Reserve, would stay low. At this time last year, the forecast was that by the end of this year, not the beginning, the end of this year, we might get one rate rise. Then that started to come up to maybe 3 rate rises. And each, when I say a rate rise, that's a 1/4 point increase. We had been at 0. We were above that, but then as during the pandemic response, it was cut to 0. So starting at 0, the response was the anticipation was that we'd be at a 1/4 point, maybe 3/4 of a point. Then some voices, including some well-respected ones, came out and said, well, we think maybe it'll be closer to 5 to 7. Okay, so that's when we started to see some erosion in stocks because it's this balance between lending rates and growth expectations, et cetera. Then what happened? Now we're starting to see expectations for 12, 13, 14. If you look on the left-hand side here, that circled number, the 350 to 375, what does that mean? 14 to 15 rate rises from where we were. Now, essentially 14. So that's now become the norm. And the rest of that chart, really, what I get off of this is that expectation hasn't changed very much. Every single day, there's a futures bet on where we might end the year. This is the expectation for December. This has wildly changed over the last 6 months, which has wildly impacted stock and bond prices. That has started to settle. Not coincidentally, we have started to see some settlement in stock prices, right? So it's not that people were, scared of this so much, they just were surprised by this, right? So now that the surprise level, for now at least, seems to have come down, so does uncertainty, because we all know uncertainty is not fun. Okay, so that's on the rate side. The other part of the Fed activity is their balance sheet. That's the right-hand chart. Starting from top to bottom, the punchline on this one is 20 years ago, their balance sheet was $732 billion. That sounds like a lot of money until you look at the bottom and see it's now at $8.9 trillion. So that is an 1,100% increase in 20 years. Wow, right? And if you look at the middle column, it's really been in 4 years that have been the real drivers of this. 2008, of course, we know what happened there. 2013 was the one that maybe slid under the radar. That was when Europe was having their own version of a credit crisis. And then you have 2020 and 21. Take a look at those two numbers and then look at where we are total. That literally is half of this total in 2 years. So that has been the monetary phenomenon here. These two aspects together, we had super low rates and you had a very accommodative Fed that were greasing the wheels for a big run up in stocks. Well, okay, that was working until it wasn't working. So these two together are the difficulties that the Fed's going to have. They're being very aggressive now, finally, and they have a lot of catch up to do.
What really jumps out to me on this chart is the year-to-date number, and you can see the 177. Inflation has been a growing problem for the last year, and the Fed didn't really see the light until recently. They were still expanding their balance sheet throughout 2022. That makes it more challenging as they start to unwind that policy mistake. But the Fed has now changed course, and I don't think markets are surprised anymore at what the Fed is doing. They're being very transparent that inflation matters, and that is their number one priority. So what has that meant for inflation going forward? And the question that we posed here is, will inflation remain anchored? And on the top chart, you can see inflation expectations over time. And, this is the spaghetti strands that you see there in the light gray are adjustments to previous expectations. So you can see those expectations have moved higher and higher over time to get to the blue line where we are now. But what I think is important is as you look out to 2023, the expectation for inflation comes way down. In fact, it comes from 9% where we are today, down closer to 4%. We'd love to see it get to 2.5% or 3%, something, closer to the Fed's target. But Bryan, is it possible for us to achieve that 4% inflation rate? Is this a realistic expectation? Or are we going to see more revisions like we've seen over the last year or so?
Well, as the inflation hawk of in the area, I would say yes, they should come down. Of course, there have been many revisions, and the revisions have not been down, right? They've been up. But I'd say here are some reasons why. Let's look at the bottom chart. The number in the middle is the overall CPI. If everyone can see that, it's 9.1. Erich already noted it. There are a few of those line items that are really close to that. And some of those should start to see some relief. But let's look at primarily, let's look at the bottom. Okay, to no surprise, the most extreme increases have been related to energy. We all know this. And the good news is some of those are already starting to see some relief. And for those to remain as they are, because this is a year-over-year comparison, right? So we're not comparing to a baseline, we're comparing to a year ago. And as a year ago's numbers started to climb back then, that makes the comparables much easier. So that is a good sign for relief. Also, for this to continue at this sort of pace, the price of gasoline nationally, sorry, California, or even us here in Seattle, where it's still pretty high, nationally, is not going to go from 5 to 7. It's already gone from 5 to 4.75 or whatever it is. They're starting to see some relief there as well. That is the good side. What could sneak up and bite us, and already is to some degree, shelter. Shelter is a broad word for, in this case, it's really applied as rent, and it's really even there applied as owners guessing what their houses will rent for. It's a terrible system, but that's what they use. And that is only at 5.6. That's the third number from the top there. Unfortunately, that one looks like it will continue to go up. So that could be one of those things to keep that number, the blue line, from going down as far as we want. But what can help it not stay up where we don't want it would be some of those other ones. So watch shelter. We are pleased to see the drops going on the energy side. Watch out for shelter.
Well, and as the Fed has raised rates, we've started to see some demand destruction or some changes in the inflation dynamic. We're going to walk through a couple of those here. You can see this chart. The blue line is our commodity prices, and we really saw a turn in June. That number didn't show up in the June CPI, which was the highest that we've seen so far, but we're expecting that drop down in prices to show up in inflation numbers going forward. You've also seen a big correction in mortgages or mortgage rates. The left side shows, and the market doesn't wait for the Fed to raise rates 15 times to adjust mortgage rates higher. What the market does is prices in the Fed expectations. So once we all believe that the Fed is going to raise rates 15 times, mortgage rates adjust accordingly. And you can see on the left chart, it shows affordability. And affordability really has skyrocketed as mortgage rates have gone up. And that's led to softening of housing prices. On the right side, we have Redfin data showing really the highest in nearly a decade of dropping prices for listed homes. We expect to see a little bit more of that. But when we get to our silver lining section, perhaps not the big drop in housing that we've seen in the past, although some give back does make sense given where housing prices have come over the last couple of years. And then kind of the last piece, Bryan already mentioned it, is rents. Bryan, can we see rents start to decline, or are we going to see rents continue to go up for a while?
I would say it'll be the latter but the key part will be for a while. So on the left-hand side, what we have here is it's a pretty compressed chart. It's just December of 20 until this June. So a rather small time period, but I think a very dramatic increase in prices, somewhat in response to what had been a period of frozen prices. So then what you get is some landlords, they're saying, okay, I need to make a correction, and the increases of their costs, et cetera. So you saw a rise, a bit of a plateau, and then another rise again. The chances that this will continue to go up, there will be a threshold, right? There is a point where people would push back and just say, no, just like they can in any other area. We do need a place to live, but it doesn't necessarily need to be, the more expensive place. It can be the less. So there will come a point of a pushback because that's just how this works. On the right-hand side, a lot of lines here, but I'll just emphasize one. The black line in the middle of this is the aggregate nationwide impact of shelter, to use the term that's in the CPI, on that number, on inflation. Nationally, that number is 5.5. You can see if you drag over, and this goes back back to 2000. So this is over 20 years worth of data. This is the highest that it has been, which is one of those things that's again helping adding to the inflationary pressures. Could this keep going up? Yes, but just like on the housing side, there will come a point of a threshold. If I'm paying less for the house that I'm then renting out, that should ripple through. But this is one of those things that probably will stay a pain point for a while. And of course, just like Eric said, a while. What is a while? That remains to be seen.
Yeah, so to summarize the inflation section, we believe inflation is coming down, but there's some pressures that will keep it or slow that process down. So it's not going to drop back down to our historical averages overnight. But as we look out to the end of this year and into the early part of next year, our expectations are that inflation, would be less of a problem and not continue to be more of a problem. So let's talk about where the economy stands. And I think this really ties back to the title of the presentation. Are we in a recession? And this chart says yes. This is the GDP Now estimates by the Atlanta Fed for second quarter GDP. And the first quarter numbers were negative. You can see we started out the second quarter. The blue chip consensus was somewhere between 2 and 4. The green line is what the Atlanta Fed estimates for the real-time estimates for GDP are. And you can see it consistently dropped throughout the quarter. In fact, it had a big drop in June and now looks to be somewhere between -1% to -2%. Now, a lot of people will associate 2 consecutive quarters of negative growth as a recession. That is not technically the definition of a recession. And there are many reasons why we might not be in a recession. But negative GDP growth is obviously something that's very concerning for investors, as well as all of us that live in this economy. We'd like to see positive growth, but let's talk about why we might not be in a recession. Look at this chart on the left side, Brian. This page is really a good news, bad news page. You want to walk us through, kind of what the good news is and what the bad news is there?
Sure. Yeah. So in a snapshot, here's where we stand right now. Why might we be in a recession? The right-hand side, and I'll explain why. Why is this seem very unusual for a recessionary period? The left-hand side. That left chart is the number of job openings. The number of job openings right now is roughly 1.5 available jobs for every person who's assumed to be actively looking. Okay. Well, of course, we're not going to all take 1.5 jobs. What a great world that would be. But the activity level is still strong. We can see starting to turn a little bit, starting to come down. Certain companies have come out and said they're freezing hiring for a little while, or maybe they're making modest cuts, but others are certainly there ready and willing to take people on. That is not what you would necessarily call a recessionary signal by any means. However, the right-hand side sure is. The right-hand side, there are 2 aspects here that are working against each other. The orangish line is the inflation rate for a given period of time. And keep in mind, this goes back to about 1975, I believe. So we're starting way high. And back then, how was sentiment? Not good, right? Because it cost so much more to buy things. Okay, then what happened? Inflation started coming down. Hey, look at sentiment. It gets better. These are directly related, right? This isn't my ability to buy things. This is how I'm feeling about my ability to buy things. What are we seeing? Back in the 10s and early 20s, inflation was very moderate. Sentiment was quite high. And then we get to now. And you can see as the orange line went up, that purple line dropped like a rock. It has since then dropped down even more. So this could be one of those things where, just like on that previous slide, even if we're not technically in a recession, if you ask, someone out on the street and that knows what that means, they're going to say, yeah, feels like it.
Yeah. So as we walk through this economic section, I think the good news, bad news comparisons are going to continue. And what that says to us is this is not a deep recession. This is not a recession like we saw in 2008 and 2009, or that we saw after the tech bubble. This is more of a business cycle recession, where we have some healthy economic data. We have companies continuing to make grow their earnings in the S&P 500, but we also have a lack of GDP growth. It's a really muddled picture. It makes it confusing for investors, but I also think it makes it easier to transition through and to make it through the other side without too much economic pain. On this chart, Brian, is this a good news or a bad news chart?
Well, once again, which side are we looking at? So the left-hand side shows me that, and I completely agree with what Eric said. If this is a recession, and I believe it either is or it will be soon, why would it be shallow and short? Hopefully, why do we think that's very realistic? Because this is more of a manufacturing side than a consumer side. And we're going to have a chart coming up just to show how strong consumers are. This is more on the aspect of our economy that is not the biggest part for us, right? As a developed economy, we have kind of moved past being heavily reliant on manufacturing and production and are more in consumption. Okay, but what does the left-hand side show? Manufacturing is not looking good. And every time that we get one of those sharp drops in that red line, it is a recession of different length and severity. That's not on here because it doesn't go back long enough, but 1990s recession is the one that I see the best references to where we might be right now, which was very shallow and rather short, but it still happened, right? The one in 2020 is an anomaly because that was kind of a policy-driven one that lasted about that long and kind of led to a lot of the monetary things that are going on. But right now, the problem is this is another one of those things that can kind of lead to this just because of the anticipation of a lack of activity. On the better side, look at the right-hand side. This is the cost of freight transport. And I know no frame of reference for what these things cost 20 years ago. It's just not something I really thought about much. But what I do know is look at that massive swell up, but then also, just as importantly, look at that very significant drop down. Just like on so many of these other charts, like commodities and such, are we still higher than we want to be? Yes. Are we seeing significant drops from the worst, or what we hope is the worst? Absolutely, yes.
Yeah, this right-hand chart really tackles the supply chain issues, which are starting to resolve themselves. We're obviously in a still very elevated place, but you can see starting to work through those issues and solve some of those supply chain, which also contribute to inflation, some of those issues. All right, so this next chart is unequivocally good news in our view. It shows on the left-hand side personal balance sheets. On the right-hand side, how much debt households pay, and then on the bottom, savings. Bryan, what's your takeaway from these charts?
So this is two very good and one not so bad, but let's just keep an eye on it. On the left-hand side, this is stellar, right? As any of my private clients know, what I always look at first is how is your asset to debt ratio, right? It's not revolutionary, it's just smart planning. Where are households at? 9-to-1. That's awesome. Absolutely fantastic. The other thing I would worry about or can be concerned about is that overly concentrated in one area? No. How do I know that? A quarter of our assets are on our home value. So even if we see some softening, I'll just make up a number and we get a 10% average annual or a nationwide drop, which just made up. That still would not have a massive negative impact because we're so well spread out in the other areas, right? Financial assets. We know that those have had some reduction in value, but we also know from the chart way back when of bull markets that it's exponentially higher than it was 15, 20, 25 years ago. Fantastic. On the right-hand side of that chart, liabilities, not only are they very containable, 2/3 of them are in mortgages. And I don't know the number off the top of my head, but a vast majority of those are at a fixed rate. So many of us took advantage of the opportunity to get a number that's in the 2s or the 3s, or even if it's a 4, even if it's a 5, that's still really good compared to history. None of those are negative, or none of those are a bad outcome. The only part of that to watch out for is the part that's adjustable, and they're absolutely out there. But as a total percentage, they're not that much in the aggregate. They get a lot of attention, but they're not that bad. On the upper right, what do we have there? The household debt service ratio, very manageable, right? We are not overextended. This is not 07 where people were applying for mortgages. They had no ability to repay or had 10 credit cards with $10,000 balances each. It's not like that. We did learn from that mistake. There have been some monetary mistakes, but they have not been at the household level so much. They've been by others. Okay, that's good news. On the bottom right, this is something to watch out for. Historically, before the big influx of cash that came in from stimulus payments, et cetera, we're not the greatest borrowers. Eric's noted before, and he's very right, that we do tend to kind of extend ourselves a bit on the national level. What to watch out for is if you see that very right-hand side with the, with that box under it, if that continues to extend itself, that's a situation. But historically speaking, that has not been a problem, right? Not so much. In certain pockets of people, of course, there always are. But at the aggregate level, a lot of that excess cash that we had has been used. A lot of it in gas for a while there, like literally. But we're still looking good. But I'd say the left-hand side, fantastic. The top right, very good. The bottom right, we're going to watch it, but so far, not a big problem.
Yeah, so in summary, household balance sheets look great. And that's important because, approximately 70% of our economy is consumer-based. So that leads us to our silver linings. And the first silver lining really is that the consumer is back. And, we haven't made it through a presentation in a couple of years without mentioning COVID, so why stop now? But we are effectively back open as an economy. You look at these numbers on the right, and TSA traveler traffic is at 95% of our pre-pandemic levels. Well, keep in mind that airlines have been canceling flights due to pilot shortages. I'm not sure we could even get to 100%. So we're flying at max capacity right now. Hotel occupancy, US seated diners, which is restaurants. We lost a lot of restaurants, and yet here we are eating out at the rate that we were in 2019. So we have really a lot of consumer activity happening. People are going out. You saw it on that last chart. They're spending their savings. They're going out and they're spending money. We have a lot of consumer activity. Bryan, there was, we've shown this chart in the past, and typically you had shown an additional data point, which was theater traffic.
Yes.
I'm wondering if you going to watch Top Gun has helped the economy or not, or how we're doing with theaters.
Absolutely. My one ticket to go to Top Gun really pushed us over the edge. But that is another great indicator of discretionary cash. It's another area, just like diners and other things, where we effectively went not to zero, but as darn close as you could get there for a while. About a month ago, saw a comparison of that most recent week to mostly weekend versus 3 years ago, versus 2019's level. It was a 50% increase. It just so happened to be when Top Gun was out and Thor, et cetera, sure. But that's the point, right? It's not one of those areas where people are waiting again. We're back, right? And that is purely discretionary. All three of these are discretionary. TSA, there could be some of that that's mandatory, sure. But all of these are, especially at this point, related much more to pleasure travel or activity than anything else. And and Erich noted it, and I'll just reinforce it. This is crucial because we are in a consumer-driven economy. We are making these choices, and us continuing to do the things that we do is absolutely essential.
So silver lining number one is that households have solid balance sheets and they're out spending their money. Silver lining number two are PE ratios. We hinted at this at the front of the presentation, but PE ratios have come back in line with historical averages. We're currently trading at about 16 times. The value portion of the market is actually trading less than that. This is held up by some of those big growth stocks that are still trading at very high multiples. So broadly speaking, the US stock market is priced attractively. Now, the question for investors is, can the E portion, can the earnings hold up? Thus far, in Q3 here, with our Q2 earnings coming out, numbers have looked pretty good. But as the Fed continues to raise rates, that makes it more challenging for companies to continue to grow their earnings. That will be the big piece of the puzzle here for equity investors. But overall, valuations look attractive. And take note, you also are getting 3% from your bonds now that you weren't getting before. So pretty much all bonds are yielding about 3%. That's not universally two, but pretty much from a 2-year on, it's just around 3% for your bonds. That's another indicator that investors think inflation expectations will come down because the long end of the yield curve has not yet pushed up higher for long-term higher interest rate expectations. So overall, we think this sets up nicely. Let's talk about just where we are, because this was one of, if in some ways, the worst start to a year in the history for the investment markets. Bryan, talk us through this chart. Tell us what's the silver lining here.
The silver lining is that we hope we track history. And what we can see on here is that the left-hand column, the first pink column shows the total return for the S&P 500 index from the beginning of a given year through the first 124, because that was the end of the quarter, trading days. We can see that we are the fourth worst, right in a line with 1940 and 1970. Okay, so you have 1932, which was the worst. Then you have 1962, and then a few that are in a box. What do we see right next to that? For the rest of those given years, for the top five, the worst five starts to a year, each one of them finished the year on a positive run. They didn't finish the year positive because, you know, the way the math played out, but each one of them turned itself around, right? So I would like to think, I would aspire to say that, you know, I would love it if we ended up like 1970. That's pretty aggressive, but something like that. The punchline on this one is that each one of these worst instances then turned into a better result afterwards. And it's very early in the third quarter, but the third quarter, seeing some solid broad gains so far. You know, still very negative. Don't want to try to, you know, paint a rosy picture, too rosy of a picture, but we are seeing it, right? And it's broad based. That's what we need. Each one of these, you know, gives us, you know, an indicator line of where we might end up. If you look down, you'd even see the ones that did end more negative. They weren't nearly as big of a drop, right? And so those are a bit different phenomenon from what we've had here. This, you know, the history tells us that there is a very good chance that we could see some rally from here. You know, I don't want to overdo it again. I don't want to say we're going to finish the year positive. You know, that it's pretty late in the year, but we're already seeing good signs. Absolutely.
Well, and let's end on our favorite chart that Bryan and I came across. If you're feeling pretty down about the economy and about the markets, you are not alone. That is nearly a universal feeling right now. If you look at this chart, this is consumer confidence and the stock market. And those big drops in consumer confidence, you know, have occurred, one around recessions. You can see the graded, the gray shaded areas typically correspond to those big drops in consumer confidence. That's yet another indicator that we might be in a recession right now. But two, those big drops in consumer confidence also have historically correlated to market returns once consumer confidence returns. So where we are today is at a 50-year low in consumer confidence, which means pretty much everybody feels bad right now. You know, people are very pessimistic about stocks, about bonds, about the economy, about inflation, and all of that has led to a contrarian indicator saying maybe this is a pretty good time to buy stocks. You know, with consumer confidence at its all-time low points. Bryan, anything you'd like to add on this chart?
I would say the two things I would really emphasize, reinforcing what Erich said, completely agree, are first one is the rallies up in stocks that did closely correspond to these dates didn't exactly marry together. Like, for example, November of 2008 was the low point for sentiment. The low point for stocks turned out to be March 9th, right? So it was a few months later, but it wasn't that far apart, you know, and the same idea for some of these other ones. The other thing that I would note is it's rather astounding that we're getting a lower sentiment rating now than we did during a credit crisis when people couldn't afford their mortgages, during an inflation period in 1975 that was 50% higher than the numbers we're seeing now. Some of this is just because, you know, everything's so hyper sort of, I want to say politicized, that's a big word, but just localized now. There's just data coming at us on a second by second basis. Are we really worse off than we were in some of these other instances? Not even close, right? I mean, I'll just close it by saying, do I think we're going to be in a mild, short recession? Yes, I do. But it is vastly different than some of these other time periods. And the idea that we got to, and I know it's kind of hard because it doesn't go on a 0 to 100 scale, but a 50 compared to some of these other instances being at like a 55 or a 60, that's absurd. We're not even near those situations. It's night and day.
All right, now with that, I just want to thank everybody for joining us this afternoon. A copy of this webinar will be available at cutler.com next week. So if you'd like to review it or recommend it to a friend, go to cutler.com and you can check it out there. In the meantime, you're always welcome to call myself or call Bryan, talk to us about anything that we mentioned today and get some more details. Or you could call your financial advisor and find out how this might pertain to you. But again, thank you so much for your time, and we wish you all a great day.
Thank you all very much.